Money printing and the rise of inequality. Hello everyone. In this video, I will explain how the growing money supply, often referred as money printing, is rapidly driving up prices of assets like homes, stocks, gold, and crypto. Actually, the asset prices are rising much faster than wages. Let's tell the story briefly in 4 points, then cover the details later. The total amount of money circulating in the economy has been growing very quickly. More money in the system drives most prices higher. Prices for assets like homes, stocks, and gold tend to rise faster than wages and headline inflation. As a result, the wealth gap between the rich asset owners and everyone else is growing. Now let's go through the story in more details. First, let's explain the headline inflation. Headline inflation is based on Consumer Price Index, or CPI, which tracks the cost of a typical basket of goods and services consumed by a household. The main components are shelter, food, transportation, and household items. Shelter costs mainly reflect rents and mortgage interest payment, meaning rising home prices due to rising land value have a little direct impact on CPI, as only new home buyers, which is a small portion of all homeowners, feel the change in their mortgage payments due to rising home prices. Now let's talk about asset inflations. Asset inflation is not a well-defined or officially tracked index like CPI inflation. Qualitatively, we can think of asset inflation as the rising prices of major investment options such as properties, gold, stock, and crypto. As you can see, over the past 20 years, home prices, stock indices, and gold price have increased between 215% and 615% in Canada, while headline inflation rose only 53% and wages increased by 84%. We can also see that the asset price growth closely track the increase in the money supply, here M2, which rose by 312% over the same period. This suggests that the expansion of the money supply has been one of the main drivers of asset inflation. Why has asset inflation been faster than CPI inflation? In simple terms, more money chasing limited asset and products pushes prices up. But why do asset prices rise even more? One major reason is technology. While technology drives down the costs of consumer goods, it doesn't lower the cost of assets. For example, 40 years ago, in 50 days, a hat chick would reach a market weight of 2 kilograms. Today, through selective breeding and optimized nutrition, it grows to 3 kilograms in the same period, a 50% increase in size. In contrast, assets like gold and land have limited supply and barely affected by technology, meaning the prices are much more sensitive to money supply growth. Now let's talk about what money supply is, which is casually referred as money printing. Money supply is the total amount of money available in the economy. There are different definitions of money supply based on their liquidity. The main ones are M1, M2, M3. M1 is the most liquid one, containing the physical cash plus all checking accounts. M2 includes everything in M1 plus saving accounts. M3 provides a broader definition of the money supply. Besides these three terms, we have M0, known as monetary base, which represent the money that central banks directly create and controls. M1, M2, and M3 are kind of a complex function of M0, but also depends on other factors. As you can see here, the growth of money supply has been significant. For example, M2 increased 312% in the past 20 years and increased 1,223% in the past 40 years in Canada. What is the role of central bank? The main goal of a modern central bank is to keep its headline inflation around a specific target, currently set at 2%. Also, they aim to keep the economy stable and avoid recessions. As shown here, M0, the monetary base, typically grows gradually over time by the central banks. However, in a specific situation, the central bank may implement quantitative easing or quantitative tightening to more actively influence the money supply. During quantitative easing, such as during COVID-19 period, the central banks buys government bonds to inject money into economy and stimulate growth. You can see it as a peak in the COVID-19 time. In quantitative tightening, the central bank does the opposite. As a visual representation, you can see the exponential growth of the money M3, money supply in Canada over the past 50 years. The breakdown of M3 component is also shown. For example, as of December 2023, the personal checkable deposit was 433 billion, personal non-checkable deposit was 370 billion, and the personal term deposit was 702 billion. As of February 2025, these numbers are 5 to 7% higher. Why has the expansion of money supply been so fast? To keep inflation around 2% and also to avoid recession, the central bank have boosted the money supply by both expanding the monetary base and also by lowering interest rates. When rates are low, borrowing becomes cheaper. Cheap money encourages people, business, and even governments to take more loans, which increase the money circulating in the economy and helps stimulate growth. If we think of cheap money as a medicine to boost the economy, the rising debt levels show that the economy has become kind of addicted to this drug. Today is extremely difficult to raise interest rate significantly without risking major financial crisis. As shown in this chart, over the past 10 years, the debt across federal, personal, and corporate levels in Canada and the US has increased significantly. A concerning point is that the debt has grown faster than the GDP during this period. In the US, total debt rose from $41.7 trillion in 2014 to $75.1 trillion in 2024, an 80% increase driven mainly by federal government borrowing. In Canada, total debt increased from 3.6 trillion Canadian dollar to 6.5 trillion Canadian dollar over the past 10 years, an 82% growth. This is the sad part, how money printing robbed the working class. Put simply, money supply growth has made asset owners richer and richer without much effort, while workers are left behind. In a way, this acts like a silent robbery. How? The wealth of the working class and middle class grows slowly through wages, while the wealth of asset owners rise much faster than wages. So the working class sees its shares of the economy shrink year after year. To understand better, we compare two hypothetical cases. One is Mr. A who invests, and second one is a Mr. B who works hard. Mr. A borrowed $500,000 in 2005 from the bank with the loan's interest tied to the inflation, and invested all the $500,000 in S&P TSX index fund. In 20 years, after repaying the loan and interest and capital gains taxes, he ended up with a slightly less than 1.5 million in net earning in 2025 without performing any labor. On the other hand, Mr. B began this with the salary of 60,000 and worked hard, and his salary rose to 110,000 by 2025. He has worked full time, saved every penny, and even invested those money in the GICs yielding with inflation. After 2 years of hard work, he ended up with the same outcome, which is a slightly less than 1.5 million. This is deeply troubling. One person gained wealth simply by borrowing and investing, while the other one worked hard and achieved the same outcome. This is unfair. This outcome undermines the value of the hard work in society. Now it's time to propose some solutions. Here we highlight three possible solutions to help reduce asset inflation and also narrow the wealth gap. First, expand the mandate of the central banks. Central banks currently focus only on controlling headline inflation. However, it may be time for them to also monitor asset inflation, make them more cautious about money supply growth. Second one, reduce government deficits. Government should avoid running persistent deficit. Deficit indirectly increase the money supply, but also growing government debt creates pressure on the central bank to keep interest rates low. And third one, which is a bit controversial, decrease income tax and instead introduce asset taxes. Today, most taxes target incomes, while assets are largely untaxed beyond some municipal property taxes. Government could consider lowering income taxes while introducing very modest asset taxes for individuals holding significant wealth. For example, asset owners with net assets over 1.5 million could pay 0.5% on the portion of their assets over 1.5 million. That means that if you have only 1 million assets, you don't pay any asset tax. But if you have 2.5 million assets, you pay 0.5% on the only 1 million difference to 1.5 million. This approach could generate enough revenue to allow for meaningful reduction in income taxes, helping the working and middle classes. If you found this video helpful, please don't forget to like, subscribe, and share it. See you in the next video.